Under the new standard, revenue from real estate sales may be recognized earlier than under current U.S. GAAP. This is because the new standard eliminates some of the current prescriptive guidance on real estate sales. The final revenue standard was issued in May 2014. This podcast will provide you with a high-level summary of the new revenue standard and some impacts the standard may have on companies that operate in the real estate industry. My name is Lauren Thomas, and with me today is Arturis Spencer, and we're both on the Revenue Project team in KPMG's Department of Professional Practice. Arturis is going to provide some insight into how the new standard will affect companies in the real estate industry. Can you start by giving an overview of the standard?
Sure. So the core principle is that an entity recognizes revenue to depict the transfer of promised goods or services to a customer in an amount that reflects the consideration to which that entity expects to be entitled in exchange for those goods or services. The standard establishes a 5-step model in order to accomplish this core principle. The first step is to identify the contract with the customer. Second, you want to identify the performance obligations in the contract. Then you'll determine the transaction price. Step 4 is to allocate the transaction price to those performance obligations. Then the last step is to recognize revenue when or as an entity satisfies that performance obligation. So it's important to note that while we're not going to go into each of these steps in any detail for the purposes of this podcast, it's important to note that each of these can be very involved in practice, and they sometimes may lead to unforeseen consequences. So really, just to tee off this discussion, the biggest impact in real estate, as Lauren mentioned earlier, is that under the new standard, revenue from real estate sales may be recognized earlier than it would be under current U.S. GAAP. And this is because the new standard eliminates the current prescriptive requirements needed to recognize full profit and to de-recognize that real estate. This change can primarily be attributed to the fact that under current U.S. GAAP, real estate sales are generally recognized when the risk and rewards of ownership have transferred, whereas the core principle of the new standard focuses on the transfer of control of those assets. There are also a few other items that I'll discuss that may impact companies within this industry. The first one relates to seller financing. So under current U.S. GAAP, or FAST 66, ASC 36020, to recognize full profit on a real estate sale, the buyer must provide a specified amount of initial continuing investment, and the seller may not have significant continuing involvement. Under the new standard, collectibility is considered when determining whether a contract exists and the sale has occurred. But there's no specific thresholds or bright lines that the seller must meet to conclude that the remaining consideration is collectible. If collectibility is not probable, the seller concludes that the contract does not exist and applies the guidance under the standard for consideration received before a contract exists and will initially recognize any cash collected as a deposit liability. The next item relates to continuing involvement. So current U.S. GAAP is very specific about what kind of post-sale involvement with the property prevent that seller from either recognizing full profit or taking that property off its balance sheet. Under the new standard, a seller with continuing involvement recognizes profit on property sales when the buyer obtains control of that property, assuming that all the other steps for having a contract under the standard exists, but it may need to continue to account for that continuing involvement separately. The third item relates to property sales with development contracts. So existing U.S. GAAP requires a seller developer to recognize the same profit margin on a sale of property and the accompanying development contract, which could be for future property improvements, amenities, roads, and things of that nature. That profit is generally recognized as a sale of the development are completed. Whereas under the new standard, the seller developer will need to determine if the sale of the property and the development services are a single performance obligation or whether they are multiple performance obligations. This may cause a difference in the amount and timing of revenue recognized on the property sale and development contract.
Arturis, when you say there might be a difference in the amount or timing of revenue recognized, what do you mean?
So that's a good question. Under the current U.S. GAAP, assuming that the future cost of development can reasonably be estimated at the time of the property sale, profit allocable to performance before the sale of land and at the time of the sale of land are recognized at the same time. and profit allocable to performance after the sale is recognized by the percentage of completion method for development and construction proceeds. This will result in the same rate of profit being attributed to each activity. Now, under the new standard, if the land sale and the development contract are single performance obligation, the accounting will likely be substantially equivalent to current U.S. GAAP if the seller developer used the cost-to-cost method for measuring progress. On the other hand, if the sale of the land and the construction contract are considered to be two separate performance obligations under the new standard, the accounting may differ from current U.S. GAAP because, for example, the overall contract's transaction price will be allocated to each performance obligation based on the relative standalone selling prices. This allocation method is less likely to result in the same profit being recognized to each performance obligation. So the last item I'll touch on is participation in future profits. So as many of you may know, under current U.S. GAAP, a seller recognizes contingent sales proceeds, i.e. those that are based on future performance, when that performance is realized. The key difference here is that under the new standard, a seller is required to estimate the future variable payment when recognizing revenue on the sale based on the total amount of consideration that it expects to collect.
So you mentioned that the seller is required to estimate the future variable payments. Is this a change from current practice?
Yeah, so this is a change from current practice where under the new standard, you don't necessarily wait until the contingent sales occur. Rather, you're required to estimate the upfront and on an ongoing basis, the total amount of consideration. Now, it's important to note that to recognize variable consideration, the seller is also required to determine that it is probable that significant reversal in the amount of cumulative revenue recognized will not occur in the future when that contingency is resolved. This limitation on the total revenue is often referred to as the constraint.
So now that we've discussed the changes to the real estate industry, let's move on to talk about the effective date, disclosures, and transition approaches under the new standard.
For public business entities and certain not-for-profit entities, the standard will be effective for annual periods beginning after December 15, 2016. So that's January 1, 2017 for calendar year and companies. And under U.S. GAAP, early adoption is not permitted. For all other entities, they have a 1-year deferral to 2018 for calendar year and companies, and a 2-year deferral for interim periods. And for all other entities, those entities will be able to early adopt at the same period as a public business entity.
Can you briefly touch on the disclosure requirements?
Under the new standard, the disclosures are going to expand significantly. They're going to be quantitative disclosures that are going to be required quarterly, including the disaggregation of revenue, information about contract balances, contract costs, and the transaction price that's allocated to the remaining performance obligations. There will also be several qualitative disclosures. As companies begin to think about their systems, processes, and controls, they should also be thinking about the data that's going to be necessary to meet those disclosure requirements. And then I'll close with some transition approaches. So the standard provides for 3 transition approaches. One is the full retrospective, where you will recast all contracts for all periods that are presented. The second approach is a retrospective approach using one or more practical expedients. An example of this may be that you don't have to recast contracts that begin and end in the same annual period. The last one is the cumulative effect at the date of adoption. So under this approach, you will record a cumulative effect adjustment at the beginning of the year of adoption. You would also be required to provide disclosure in the period of adoption that include or that show the impact of the change on each financial statement line item. You'd also be required to account for the revenue transactions both under the new standard and under legacy GAAP in the year of adoption to determine the effect of that accounting change. So with that, Lauren, do you want to close it out?
Thank you, Arturis, and thank you, the listener, for joining our podcast today. For additional information, refer to KPMG's Financial Reporting Network, including the latest on revenue recognition page, which links you to KPMG's analysis of the new standard, including defining issues, issues in depth, webcasts, and other podcasts.